This video is sponsored by Terrell Hutton, who makes the invisible investable. Today on the CEO Barbecue, we're looking for gold in Nevada together with A2Gold. For a bullet point summary of this and all other CEO interviews, please go to resourcetalks.com and subscribe to our free weekly newsletter. The company you're about to hear from has not paid us for the production of this interview, but this interview is still intended only for experienced speculators because this is venture capital and mining is a very risky industry where failure is the norm. All conversations are general and impersonal in nature, and they contain forward-looking statements. I'm not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital is at risk, and also visit setterplus.ca where you'll find the company's official filings. If you're not 100% sure you understand all the biases and the disclaimers that I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That all said, you might actually know this company under a different name as it rebranded in the second part of last year from Allegiant Gold to, again, now A2Gold. And they also have rolled back their shares count, by the way, in the first half of last year. That was followed by a $10.5 million financing. Financing was led by Kinross Gold, and it put Kinross at about a 9.9% ownership on a partly diluted basis. A2 is a gold and silver explorer, 100% focused on Nevada, multiple assets there, the flagship of which is called Eastside, and it's located in Esmeralda County, which is roughly 20 miles northwest of Tonopah, which, if you knew your Nevada geology, which I can pretend to know because I'm actually reading it off my notes here, is actually in a structural corridor known as the Walker Lane Trend, which is a gold-bearing belt that has what's hosted a lot of gold discoveries, but also some of the better precious metals mines in the U.S. over the last couple of decades. A2 now has been drilling this project for a while, since 2014, actually, and the most recent resource they have on it is from 2021. It's showing about 1.5 million ounces of gold and just under 9 million ounces of silver as a pit-constrained inferred resource that is hopefully going to be heap leachable with an average grade of about 0.5 gram per ton. But those numbers may be changing soon because one of the company's priorities for 2026 is to come up with a new and an updated NI 43-101 containing the results from a lot of the drilling that's occurred since that last resource that I told you about. That's an inferred resource, by the way. But also, they recently started the largest drill program in the company's history, which is an expected 30,000 meters of RC drilling at the Eastside project. Drilling this year is also expected, by the way, to test other targets where geological mapping and geochem data shows potential for more oxide gold. So shallow, and that's something we'll talk about as well. Because what else needs to happen before that, and when are those assays expected? How much are they spending on a program? Those are, of course, going to be part of the questions later on. Now, for some of the numbers and a little bit of the details, A2 is listed as essentially gold. So it's AU on the TSXV, where the average 3-month volume is about 160,000 units. The 52-week high is $1.46, and the 52-week low is 10 cents. So it did go up a lot last year. Also something else we'll touch upon later on. With just a little over 104 million shares outstanding and an $83.5 million market cap. Today, this is an 80-cent stock with a 50 and a 200-day moving average at respectively 104 and 81 cents. About 16 million warrants are outstanding, together with 4.3 million options and 3.3 million RSUs, all together representing about 18% of the company, or 18% of the 127.6 million fully diluted shares. Management and insiders here own about 1/5 of the company, or 21% to be specific, while, as mentioned earlier, Kinross owns close to 10%, and other corporates own 4%, leaving about 2/3 of the company in the hands of assumed retail with some institutions here and there as well. Is that who's going to keep funding the company in the future? How much money do they have right now? When's the next financing coming? And what happens in between now and then are, of course, also going to be part of the questions that I plan on asking later on in the conversation. But for this to actually become a conversation, I might have to shut up already. And Peter, I'll give you the word. But first of all, thank you so much for sitting down with me today.
Oh, thank you. It's a pleasure to be here, and looking forward to the conversation.
I'm looking forward to going over the basics here in a minute as well, learning more about A2. But just before we get into all of that, the most fundamental barbecue question for you: how do you like your steak?
Well, depends on the cut, but generally medium rare is my favorite.
I don't think I've had a better answer actually. When you led with depends on the cut, I did have someone tell me that they like it well done twice now in a
No,
row, and I almost had to close the laptop and pretend that the Wi-Fi fell
yeah,
off.
irrespective of the cut, that well done is never acceptable.
I agree. I absolutely agree. Rarely is it acceptable to go above medium rare. Actually, well, there's a couple of cuts, but anyways, this could turn into a barbecue podcast eventually. This is jokes aside, we'll do a deeper dive into some of the details on A2 later on as well. But maybe just to set the stage here first, and then we'll go and talk about your background and whatnot. What's the end goal for this company now, knowing what you know now? Are you building for kind of for growth? Do you want to bring this into production yourself potentially, or are you building this for takeover?
I mean, the quick answer is we're building this company to be the leading junior gold silver company in Nevada in terms of size, in terms of resources, and that we believe will lead us into to be an acquisition target for a major company that's looking to come into Nevada or expand their resource. And we believe that number for any company, gold, silver, to be able to have a viable success or exit strategy would lead for a company to have any north of 3 million ounces of gold resources. And you can say gold equivalent. I'm not a big fan of gold equivalency, but just for simplicity, gold equivalent ounces. The higher the number, the better. And I think the more attractive it makes you. And obviously, the higher that number in one project versus multiple projects is even more favorable. But our goal is to build a company that has 3 to 10 million ounces of gold, preferably in one or two projects put together. And it's notoriously difficult to find 2 and 3 million, 4 million ounce deposits, particularly oxide deposits in Nevada, and with great infrastructure. But the numbers can be lower in Nevada simply because most of the majors are already there, they're already operating, and the infrastructure is just so favorable to building a mine. So to simplify and to get straight to your answer, our goal is to build it to sell it.
I like the straightforward answer, and I do want to know more about that. But people listening should also want to know more about Tara Hutton, who doesn't only make the invisible investable, but they've made this video free of YouTube ads by sponsoring it. Tara Hutton is built for the people who are tired of going through boring PowerPoint decks and geological jargon when they're analyzing mining companies. It's a digital platform where the data, the story, and the context sit together so mining investors can use visuals to understand the why without needing a geology degree or a week off work. And if you're on the company side, it's a great way to present your project like a serious operator with everything investors keep asking for in one place. Contact them at terrahutton.io. You're reminding me of something. We'll definitely go into some of the details. And I'm glad you brought up size, because my question would be, how big does it have to be in order to be sold? What's the grade that it has to be for it to be attractive in Nevada? And we're definitely going to get to those details later on. But since this is your first time on the barbecue, we'll have to take a step back and go through what I call the smell test, which is aimed at understanding the incentives and the track record of management. And I want to start off with yourself and your track record. Who are you, and have you made money for shareholders in your career so far?
Yeah, so I started my career in the mid to late 90s at an investment bank called Salomon Brothers, one of the premier investment banks at that time. I was an analyst there, and then became a member of their hedge fund group in 1997, still called Salomon Brothers, and be able to build that fund into a $5 billion fund by 2004. Went through a few of the mergers with Citi and then Travelers, or Travelers and then Citi. And then we ended up spinning out of what was later called Citigroup, although our fund was still called the Salomon Brothers Hedge Fund Group in 2004, at the end of 2004. And in 2005, I sold my equity back to the partnership and started my own fund focused on junior mining, called the Carrollton Asset Management Fund. I did that from 2005 to about 2016, 17. Closed the fund out for outside investors, been returning capital, and the fund still exists. It's primarily most of all my capital that's still there, with some outside investors that are still remaining, and mostly family and friends.
Do you guys
But
make
that's
money
what
in
I
that?
did.
I'm sorry for interrupting, but just kind of out of curiosity, as someone who deploys capital in this space myself, do you guys make money in that period, 05
Yeah,
to
I mean,
16?
we were one of the, I think we were ranked one or two by Barclay Hedge in 2008, 9, and 10. So we had a great run during that period of time. Our largest investments were in the uranium mining sector. Gold was significant, but we were a large investor in uranium in 2005 to 2011. Then Fukushima hit. Clearly, we took a nasty spill as a result of Fukushima, and then tried to recover back over those years, and been able to recover most of that since then. But it just was not. It wasn't fun for me anymore after having done it for over 20 years. And I decided to get more involved directly in the management of company. Part of it was I was extremely frustrated how most of the junior mining companies are managed. And so I felt that the best way to change the industry, or at least put my own fingerprints on it, was to get involved directly in management, which is interesting because I've done it from the buy side, from the sell side, and now from the management side, and sat on board of directors, as well as now the CEO of A2, previously called Allegiant, for the last 6 years. But going back to your question on our fund, we had probably one of the best runs of any funds over that period of time, and then clearly because of the uranium industry, and then that was coupled with a collapse in the junior mining industry, ran into our own share of issues during that time. But we've been able to weather it, and still exist, and we're just not open to outside capital.
Mm-hmm. Do you currently do anything else outside of that? Do you have any other executive or board positions that are taking up any of your time?
No,
Okay.
I'm on the board of directors, but not an executive board.
Yep. Right. Okay. So this is essentially your full-time
It
job.
is. I'm full-time dedicated to this, and the fund, which I had previously mentioned, still exists, but it's
Yeah.
primarily my own capital, and we do invest in other juniors as well as in A2Gold.
Oh, good. Well, this actually is a good transition maybe into talking about incentive, which is, as I said, I want to talk about. And I believe skin in the game is kind of the biggest incentive management can have. 21% is what your presentation says. That is for management and insiders. How much of that is you personally, or kind of your related parties, if you will?
Yeah, so I own about 8% of that of the company. So 33% of that, or 35% of the total 21%. 8% is what I own of A2Gold. I agree with you. Skin in the game's probably one of the most important things, but I would characterize it a little bit differently. It's how much money do you have invested, actual
Yeah.
money. I came in to take over A2Gold in a very, very bad situation in 1999. The market cap was $2 or $3 million. It had essentially no money in the bank. It really lost direction, and then I really didn't have any shares invested, so I took over the company, invested over that time. And not just myself. I would say management directors have invested a combined $6 to $7 million of their own money, and so, going back to your skin in the game comment, I think skin in the game is important. Well, skin in the game, that doesn't mean what your share position is. How much money do you actually have invested into the company? There's a lot of these, junior companies in which they got founder shares at a fraction of a penny.
Mm-hmm.
And yeah, they may own 10 or 15%, but they have no real capital invested in the company. I would think more or less that 80% of my position has been bought, if not more, has been bought in the open market. As any other investor competing to buy a share, I, as well as my other directors, have been buying stock in the open market. I think we're the single largest buyers of the stock in the open market over the last 5 or 6 years.
What's your average cost of the 8 million or the 8% that you own right now?
Yeah, my average cost is about, so I'm going to adjust it to the post rollback,
Yeah.
is roughly around 34 cents.
Right. Yeah, that's exactly what I'm checking for. Founder
Yeah.
shares, half a penny, a tenth of a penny type of stuff is what I'm looking for. Is there, I mean, the company's existed for a while now, but is there any kind of cheap paper within or outside of what management owns, or either with the shell or however that the company got started?
No, no. There was no cheap paper.
Yeah.
Never.
That's the right answer. Just like with the stake.
Mhm.
This what do you make of the valuation where it is right now? Kind of from this, an interesting question specifically for you because you understand it from the investment perspective side of things. You're even after the current dip they were going through here, which I hope is a dip and not the end of a very short bull market. Um, your stock is double the GDXJ over the last 52 weeks. So you're doing very well. Last year went up a lot. Is it kind of making you uneasy? Is it getting overvalued? I suppose you'd never tell me your company's getting overvalued, but from the investment perspective, how do you justify this valuation?
I mean, the way I look at it is what do we have and what's the potential to make it bigger? And we briefly touched on what it's going to take for a major to buy a company or a project. I think that, just from that perspective, at 1.5 million ounces of gold and 9 million ounces of silver, we're extremely levered to the price of gold because, when you have a project sitting at zero point 0.5 to zero point 0.7 grams a ton, roughly, and ours will vary around those areas, and we'll talk about the project in a few minutes. But those are sensitive to the price of gold. Our project at 1,600 gold probably doesn't work well. At 2,000 works, but the IRR is low. But then now you get all of the inflection points when you start moving to 3,000, 4,000, 5,000, and if you were just to do, plug it into ChatGPT or Gemini or Cloud or whatever and come up with your own net present value of the project. But it's multiples of what we're trading today, right? And that's even after using a large fixed cost for building a mine and your cash cost depending on what your strip ratio is going to be. But to answer your question, I think we're grossly undervalued given what we have and the potential to be significantly larger. I would also add that this most recent pullback is fine for us. We're not concerned about it at all. We're sitting on 15 to 17 million in cash, and we are in a very, very strong position. It would be nice to be back to $1.40, $1.50, because what I would do with that if everyone else was, there's going to be a lot of companies right now that are not going to be able to raise money, given the recent pullback, and that presents an opportunity for companies like ourselves who are looking to bolt on other acquisitions and use our financial strength and our balance sheet to acquire, a few good projects that are still there. Now, we've spent 6 years essentially selling down our projects from 13 down to 3. And we did that in a very difficult market. And the reason we did that is we didn't want to dilute. We hadn't done a financing in over 3 years. And the way we survived was by selling down our projects. Now we've turned this, we've turned the corner, and now we're in a much stronger position relative to our competitors, and not all of them, but most of them, the industry. And now we're able to pick up projects on pennies of the dollar for what they're worth. But back to your question, I think we're very undervalued relative to this. Now, when I was at the fund, I created a different methodology of how to value junior companies. So if you look at historically, I mean, I've never been a big believer of just a number of $30 an ounce or $20 an ounce for gold for a resource. That to me is silly. If when in 2006, inferred ounces were going for $50 to $70 an ounce, but gold was 600. So inferred ounces, and what I developed, was a methodology, simple methodology that says what are you valued as a percent of spot price of gold, right? So the peak I've seen was in 2006, 7, where inferred ounces were going for 8 to 10%, and let's call that the peak. And then the low, call it around 2015 to 16, was trading at 0.3%. of the spot price of gold inferred. The average historically over the last 30, 40 years is around 3 to 5%. That's the average. That encompasses bear markets and bull markets. So at 3% of a 5,000 gold price, that's $150 US an inferred ounce, and that would put you at the bottom range of the historic. Mm-hmm. In a bull market, you're going to see 6, 7, 8, 10% of the spot price. Now, if you want to work back into it as opposed to looking at it from a top-down perspective, it kind of makes sense too, right? If you're paying 5% of that resource of the gold price you're going to get, and then you have to build a mine, you have to permit it, you have to get through everything. It kind of makes sense, that 5 cent number. It's kind of like a royalty essentially, and that's the value I think that historically companies should be traded at. And it's not just us. I think the whole sector is undervalued. I think we're undervalued not only because we have a fairly large resource, but our ability to make this, to double or triple that, given our land package, given what we know about the deposit, and the potential to find additional ore bodies within Eastside. So put this together. It's a long-winded answer. We are undervalued by two metrics, in my opinion. One is as a percentage of the spot price of gold, so inferred ounces. And then the second is more related to us is our strong balance sheet, cash position, and I guess three would be the ability to Eastside to or the significant potential opportunity for Eastside to grow much larger.
Mm-hmm. Good answer. Setting the stage well for a lot of conversation later on. I will actually go back to skin in the game because that's something I didn't ask that I should have. Royalties. Do you or any of the other insiders personally own a royalty on this project or the new one that you're picking up right now?
No.
Good. Short and sweet, as it should be.
Insider meaning management directors, no. I mean,
or related parties, or like someone who might be, biased in a different direction.
Yeah, I mean, it's a fair question. So let's go back to the history of Eastside and how it was discovered. Sure. Eastside was put together by Cordex in 2010 and 11. Cordex was founded by John Livermore, who's widely credited as the discoverer of the Carlin trend when he was at Newmont in the 50s, 60s. I think it's almost indisputable that the individual who discovered the whole concept of the Carlin style type of deposits, and that was John Livermore. John Livermore was a founding member of Cordex in the 70s with Andy Wallace, and they created Cordex and have put in 7 or 8 mines into production in Nevada, if not more. They made significant amount of discoveries. They were one of the founding members of what is today A2Gold. John passed away in 2011 or 12, and he was just an amazing person. Cordex did have a royalty on every project that they put into A2Gold. So I don't know how, it's not, they were a third party at that time, but it was part of the agreement when A2 came together, or Allegiant at that time came together, was that their projects and the way they earned their equity was through farming in some of their better projects or not farming in, actually contributing their projects into A2Gold. I'm going to use A2Gold, but there's a predecessor to that just for simplicity purposes.
Sure.
No management or insiders or executives have any interest, equity, any royalty interest.
Yeah, that's that's exactly what I'm looking for, and I think this mud covers the smell, what I call the smell test. And typically, when I'm done with that, I do like better understanding the asset, and in your case, specifically, what might help me understand it is talking about what you were just mentioning earlier, which is the history of the asset and how it came together, specifically from the perspective of, like, you started drilling this about 12 years ago. Yeah, 2014. So 12 years ago, 80,000 meters of drilling since, soon to be 110,000 meters with this 30,000 meter program now. And the resource is still only inferred. Why is it not at a further state? Why is it not a PEA or even PFS or even sold already?
Yeah, so those are really good questions. I think I'm going to segment it into two parts. Why has it taken us this long? Because I think that's a fair criticism. And I think the second part is, why aren't you moving to M&I or something else of that nature? So The first part is understanding a little bit about the history. Eastside was, essentially discovered in 2014 in the midst of a very, very bad bear market, and the predecessor to Allegiant was actually spun out of a company called Columbus Gold. So Columbus Gold was essentially Allegiant for a period of time until Columbus Gold in 2010 acquired a project in French Guiana called Montendor. And from 2010 to 2018, Columbus operated as all these Nevada assets, which is Allegiant A2, and a second internal company, which became Aurea Mining in 2018, that had this French Guiana 5 million ounce project. Amazing project, but it was in French Guiana, which is essentially is a province or state, département of France, similar to Alaska to the U.S., which it's not essentially attached, but it is part of the U.S. The reason that's significant is that all of the capital that Columbus had at that time was going to the French Guiana asset, and very small amounts of money would leak back into the Nevada assets, and that led to the decision by the board at that time to split off the companies, one becoming Allegiant Gold in the end of 2017, beginning of 2018, and one becoming Aurea Mining. So now you had two separate companies. Now Allegiant becomes the sole operator of these primarily Nevada assets. Now in a very, very difficult market with very little cash in hand, they can't really advance the project fast enough. Now they have drilled 80,000 meters over those 10 years, something that should have been done over a 2 or 3 year period of time had we've been in a strong market. When I took over the company at the end of 2019, as I said, there was almost no money in the bank. There were some great projects, but without money, you can't really develop great projects. So I took the decision to start selling I had made the decision that Eastside was the core project and that we were going to sell the non-strategic or core projects that we considered the core, and we did. And it turns out in retrospect an amazing decision because we were able to keep our share structure intact. I was very, very concerned about dilution because I had put significant amounts of my own money into the buying shares of the company. So the last thing I wanted to do was take on a horrific dilution during that period of time in a bear market. Diluting in a bull market is not a bad thing. Diluting in a bear market is a very bad thing because it's not an accretive way of raising capital. It doesn't matter what you do, the market's looking for reasons to sell, not to buy. Now, going back to your second part of the question about, which I think is more is why not go to M&I. I'm a firm believer that not the only, but the primary reason you go to M&I is when you are focused on the economics of the project. Okay, so we will go to M&I at some point in time. The thing is that we didn't have enough money to properly explore the entire part of the project, mind you, let alone the decision to move to an M&I decision. I will say that the most likely acquirers of us, and you can probably come to that decision who would be the most likely acquirers of us, have zero interest in us moving to M&I. Zero, not even a little bit. It's the reason is that they share the same philosophy that I have, which is if I have this amount of money and I can move a project from part of our ore bodies in from inferred to M&I, or the second decision is use that money to find additional ore bodies within the property. Well, I'm always going to choose, let's drill out the property, let's find out what we have, and then come back and focus on the economics of each of these projects. Now, that's predicated on the fact that prior to announcing this drill program, we had only drilled about 18% of the targets at Eastside, not of the property, the targets. It's a misconception to say we've only drilled 18% of the property. Well, because 40% of a property or 50 or 60 or 20 is going to be just land that you'll never drill anyhow, and you have that for other reasons. I'm saying we've only drilled 18% of the targets. And so for me, the most important thing now is drilling it out, then taking stock of what you have after that, and then moving it into a PEA or I'm not a big fan of PEAs, but a pre-feasibility study, which would be a little bit more relevant, and that requires moving it into M&I. So we have, just to take back on Eastside, to go back to Eastside, we have two known ore bodies. In the north is McIntosh, and in the south is the Castle project. Those two are separated by about 12 to 14 kilometers of distance. There's an entire length between McIntosh and Castle of a minimum of 3 to 5 potential ore bodies that we think potentially could be, but that have to be drilled. And of those potential ones, a lot of them aren't just going to pan out, but you may find another one or two. And that changes the economics of the project as well, because today you're not going to just build a heap leach between those two areas and then, truck ore 7 kilometers one way or the other. You need to find out, are there other ore bodies within that strike length of 12 to 14 kilometers that can be put into production? Then you come up with a general mining plan that encompasses 2, 3, 4 ore bodies, and then now you're reaching tremendous amount of scale in putting those into production. I'm not a fan of moving to M&I unless you've, and I'll repeat that, I'm not a fan of moving into M&I until we've spent all the money in eliminating or finding additional ore bodies. Then you can move and focus on the economics.
A lot of food for thought there. A lot of stuff that we can talk about, and well, this might actually be a good point as well. But what would it have to look like from a grade perspective in a PFS setting? So when you get it that far up, that you've done a lot of metallurgy and everything else in between, which I hope to talk about as well. But what would it have to look like from a grade perspective in order for it to be profitable or buyable, which are often the same thing in Nevada, specifically in this setting?
Well, I mean, the average heap leach mine today in Nevada is producing at less than 0.4 grams a ton. I think it's 3.37 heap leach. And all of those are making significant amounts of money. Now, mind you, they also have the fixed cost already, as the sunk cost, right? So you're just focusing on operating cost. Mm-hmm. I think that at current metal prices, I mean, any heap leach with over 0.3 grams a ton, not in production, but have to put in the capex, is a go decision for building a mine. It's just simple math, right? If it depends on what the strip ratio is, it depends on what you're going to be producing in terms of leachable, the leachability of that heap leach. But just using standard 70% recoveries and 20 to 25, 30% in silver, most heap leaches today at 5,000 or 4,500 gold are extremely profitable. From our perspective, we think that McIntosh, we need to drill. McIntosh is a little bit different than Castle in that there's high grade chutes there. We need to further analyze those and try to ensure that we understand fully well the source of those high grade chutes, and because high grade is going to essentially require a milling operation, while the rest of what we call the cloud or the exhaust, if you want to call that, of the 0.5 to 0.6 to 0.7 grams will be heap leached. At Castle, the difference is that Castle's essentially at surface. We believe that Castle has also significant expansion potential from a resource side. It has the benefit of being closer to surface and lower strip ratio. It just is not as large as the potential for McIntosh, and most likely doesn't have the high grade, vein nets and that are associated with McIntosh. So I think they're two different ways we'll approach it. But from a PFS or getting to your grade question, once again, I think all of these things are extremely profitable at current grades. Although we do think that our project, some of the things that we're seeing are, there's a potential for even increased grade.
And that's this, because you're targeting an updated NI 43-101. What in next year? When was that? Because I think I mean
No,
it's been.
no, it'll be this year. We started drilling RC about a month and a half ago. We're probably 7 or 8 holes into it. The first 3, 4, 5 holes are in the lab right now. We believe that we're going to come up with an updated 43-101 at Castle and Macintosh, and then combine those together into the Eastside 43-101. And depending on how fast drilling is going, we may want to bring in a core rig. And one of the things that I think has changed a little bit since our announcement of 30,000 meters of RC is we believe that given the geology of Macintosh and some of the other areas, we need to bring in a core rig to test the higher grade vein system better. Mm-hmm. So we may add a core rig in there, and I'm pretty confident we're going to add a core rig.
Fair, and we'll get to that as well. RC versus core, interesting to me as well as to why you made that choice. Are you guiding anything for this next update though? I mean, is that when you get to the 3 million ounces that you think is needed? What are you guiding in terms of maybe size and grade?
Well, we don't guide until we have a good understanding of the assays that are coming out. I mean, the last 43-101 was done when gold was 1,700, I think, and silver was 23. So we don't want to come up with a resource estimate that just adjusts for gold or silver prices, because that, clearly you're going to have more because you're going to be drawing in what was previously not economical. I think that our size at Eastside, just given the proximity to Round Mountain, I think the size that's required for us and companies that are close to Round Mountain or have in Nevada have a project is a little bit different than someone else who's just maybe like 500 kilometers away in Utah and looking for a major to buy them. So I think we need to be to 2 to 3 million ounces, and I think that any other new project needs to be above 3 million ounces that is not necessarily in proximity to a major company with a major project, like in our case. I've always thought that 2 to 3 million is really where we need to be. We're not guiding to that, but I think that's where we need to be.
Mm-hmm. Is that achievable if Macintosh and Castle don't connect at depth?
Well, I don't think they connect. I think there's other ore bodies, potential ore bodies between those two, right? So right now we have 2 ore bodies at Eastside. I believe there's at least one more, and it's not just me. I think most of our geological team, and I think also our technical committee team, which includes Kinross, also believe there's another one, potentially 2 ore bodies between Macintosh and Castle. And then I think you take stock of what you have after that. And I think that Macintosh and Castle together absolutely have the ability to be 2 to 3 million ounces just without finding another ore body. And maybe even significantly larger than that. But I do feel comfortable just knowing where gold price and silver prices are today. Silver was never included at Castle in terms of our last resource estimate. That 9 million ounces of silver just comes from Macintosh, although Castle is running 50 to 100% higher in silver grade than Macintosh in the historical assays or the assays that we've drilled. I mean, I'd be shocked for us not to reach the 2 million ounce between at Eastside in the next 43-101. But anything could happen. Mm-hmm. I'm concerned, more focused on improving grade and also the size. And we think that improving grade is just a few adjustments we need to make in the way we assay RC. If you have coarse gold, which we believe we have at Macintosh, then RC doesn't necessarily capture that and capture the grade. And that's one of the reasons we're bringing in a core rig.
Yeah. Fair. And again, I do want to get to that. What about the deeper portion of the deposit? I mean, you're already at almost 500 meters depth that you keep finding mineralization at, which is, it's already getting rather deep for an open pit, right? And so the strip go ahead.
Yeah, we don't consider that open pitable, but we would consider. So I think the real potential at McIntosh is a hybrid type of mining operation for someone with deep pockets, where you have a underground component and an open pit component. Round Mountain is moving now from an open pit only to an underground and an open pit, right? So, you know, Kinross discovered what they call Phase X, and Phase X is that underground portion of Round Mountain now. And Round Mountain is a open pit and will be an underground and an open pit operation at simultaneously. And so I think that McIntosh has similar potential to be an underground and an open pit. Now the question is, how much further can we drill down to extend mineralization? And then the next question is, should we be doing that, or is that we should, we've already proven that there's mineralization at depth. Why don't we let that? That's a very expensive drilling. Each of those holes can be $250,000 to $350,000, $400,000. Should a junior spend $400,000 per hole? I'm not a big fan of that. It really depends on the environment. If we had a $50 million balance sheet cash position, then maybe it makes sense to sink 2,000 or 3,000 meter holes to see how deep it goes, because those are extremely high grade potential. Or you can do what we've decided to do is, okay, we've proven that the mineralization extends at depth. How further? Well, either we'll have 50 million in the bank, or we'll let someone else drill that out if they acquire us. And let's focus on more shallow, easier to put into production type of resources. If Eastside works extremely well, given the infrastructure, the water, the electricity on the property, works really well down to 250 open pit, 300 meters open pit. I mean, those are all doable given where gold prices are at, right? And silver prices. So our whole goal is to find another one or two ore bodies, shallow, and then look at the entire picture of a 3, 4, 5, 10 million ounce deposit. I don't know. We haven't closed the conversation of us being a significantly larger deposit. And then look at what it's going to cost to put and how you would stage those ore bodies into production. But that's a big company decision. I believe that publicly traded companies, one of the things we haven't talked about is, I believe if you're a publicly traded junior company, you need to go big. There are some amazing 300 and 400,000 ounce projects out there, and those are all great. But those shouldn't be publicly traded. Those are perfect private company assets. If you're a publicly traded company, I'm a firm believer that you need to have significant size potential. Why are you public? Right? There's no attractiveness, in my opinion, and having been a fund manager for many, many years, I'm not attracted to, from a publicly traded basis, of a company having a 300,000 ounce deposit or 400,000 ounce gold deposit. Some of the best deposits are those 400,000, but those should be in the domain of a private company.
Yeah. Another good topic that actually you and I can have, because you do come from the investment side of things. I think most companies that are on the venture now should be private companies in the first place, or should remain private for a longer time. But that is a topic in and of itself, really, though. How deep are you going to drill it, though? Or how deep would you want to keep chasing it?
No, I think at where we're at today, we're pretty satisfied what we've proven. Okay. I'm not in the camp of drilling a core hole 600 meters. Mm-hmm. That could change. Environments change. Your cash position changes. Geology, new information comes. But for us, 600 meters is a $300,000 US hole. Mm-hmm. Yeah. For all intents and purposes, including everything, water, mud, assays, the drill company, per diems, everything, all in. That's a $300,000 hole in Nevada. So yes, we do have the money to drill that. There's no doubt about that. But does it make sense of drilling a 600 meter one hole, or should I drill 1,000 meters at 200 meters each at the same price, right? So 4 or 5 core holes down to 200 to call it 4 holes at 250 meters each to test 4 different areas core, and your cost goes from $500 a meter to about $350 a meter in Nevada, right? So obviously, as you get deeper, the costs start increasing exponentially. You can drill effectively. We can drill a core hole 200 meters basically for $320 a meter all in, 330. But that same core hole, 600 meters, is going to be $500 a meter, right?
Yeah.
And so one has to make that decision. And if you're a junior company that relies on capital markets for cash, I mean, that's a pretty big bet when you're going to go down 600. I mean, I know that we've had this conversation with Kinross, an 800 meter hole, right? But that's something I don't feel comfortable doing.
Yeah. How deep is a sulfide contact? Where does that start?
It's a great question. We've been shocked, not surprised, actually shocked that we're not seeing sulfides. I mean, clearly it's not uniform, but roughly 400 meters. Usually sulfides you're encountering them at 180 to 250 essentially meters from surface, but it's been a lot deeper than we expected. We would have expected more sulfides sooner or at closer to surface. That hasn't been the case at Eastside.
Yeah, interesting. Yeah, and that makes more sense now, even more sense now than just the depth of it all. So the drilling that you're doing this year, the 30,000 meters, what's kind of the distance between the 2 furthest holes that are from each other, if that makes sense? Like how much are you going to be stepping out across the whole thing?
Yeah, so I think there's 3 main objectives, and the 30,000 meters may change because we may just use the RC for exploration, and this kind of gets into this conversation of RC versus core, right? So there's 3 objectives or 3 targets that we're shooting for in the program, irrespective of RC or core, and we'll talk about that in a minute. The first is infill drilling to connect certain areas within McIntosh and Castle within those areas, and they're a little bit different. So I'll start off with McIntosh. Some of those holes are there to get a better understanding of grade and controls, and that may require core, and that may lead to 2 scenarios or a combination. One is higher grade, and 2 is higher resource amount. At Castle, so this is still the first objective. The infill drilling, what we would characterize infill drilling at Castle, is connecting some of the subzones that still have holes that are 500 meters apart, right? And so we're not able to draw those into the resources because they're so far apart still. So drilling holes and trying to connect some of the subzones at what we consider at Castle. We consider that infill drilling. The second component or objective is actually step-out drilling. And we define step-out drilling of up to about 100 meters, essentially, from the pit shell design at McIntosh, for example. And that is to test certain targets that we believe can extend those pit shells primarily to the south and to the southwest of the current pit shell design of McIntosh. And I would expect that those are going to be around 8 to 10 holes at McIntosh. Castle, now we're getting into a mix between what is considered step out and what is considered infill drilling, because there's 3 subzones within Castle, and our first objective is to connect those subzones because the distances are only 700 meters between those. So that I'll leave the step out and the infill drilling at Castle because it's kind of like a gray area. What would be considered step out and what would be considered infill. Mm-hmm. The third objective is what we discussed earlier, is that we've only tested 18% of the targets. And so it's heavily focused on, so those first 2 things we talked about, step out or infill and step out, will have a direct effect on the 43-101. The third objective and the largest part of the program, and so going back to 1 and 2. So 1 and 2 will be primarily our core and RC combination. The third component is to test, and it'd probably be 40 to 60 holes total of the exploration targets that we've identified as a result of geochem, some of the sampling we did, and then 2, 3, 4 types of geophysics programs that we did recently. And I said it in a meeting yesterday for, some time, talking about the most recent, I think it's called hyperspectral analysis. And we looked at the results, and we're overlaying that with some of the air mag as well as the gravity that we shot late last year. We have a bunch of targets that we need to drill, and we now have a very good understanding of those targets and what what the geophysics is telling us and how that relates to the Macintosh and to Castle. And now we're able to compare and correlate those type of targets together. So a significant part of the RC drilling, this will almost all be RC drilling in the third bucket, which we call exploration drilling, will look to discover additional ore bodies within the Eastside deposit as a whole. So those are the three components of that. I can see that. I think it's fair to say that we'll probably drill up to 15,000, maybe 16,000 of the RC of the total meters will be focused on the exploration side. The other previously, call it 12 to 15,000 meters of the total 30,000, which was the RC, is probably going to be shifting to some core and some RC based on what we've seen. And so there'll be RC drilling for exploration, and then there'll be combination of core RC for the updated 43-101 coming up. Mm-hmm. It's a lot to unpack, so I apologize if it's confusing.
Just about anything is confusing to me, so you don't have to apologize to me. No, I'm just kidding. It's not confusing. I think I am following your general train of thought here. What's kind of the timing on doing all that work? You're doing some of it now. How long is it going to take for you to finish it?
So we started drilling about a month and a half ago. RC maybe close to almost 2 months, a month and a half ago, and depending on what we do with RC versus core, I think we'll be able. Core is a lot slower than RC. I think that we will be drilling up until probably September.
Mm-hmm. And assay results, how are you going to do that? Kind of not one by one, I assume, but maybe region by region, or?
That's exactly right. We're never one-on-one. It's never been our style. We'll never adapt that, because you need to look at all of those drill holes in a specific area. The area needs to be analyzed in groups.
Right. So the new targets that you're going to be exploring, how far are they from the main deposit areas, the two deposits essentially?
So we're focusing in this program in the, call it 3 to 4 target areas that are slightly closer to the Macintosh. So Macintosh at the north, Castle in the south. The targets are about a kilometer south of the Macintosh at the closest point, and then they go down another 6 kilometers down. So it goes from a kilometer from Macintosh all the way down to almost the midpoint, or slightly past the midpoint between Macintosh and Castle, if that makes sense. So we're targeting around a 6 kilometer strike length, call it 3 to 4 target areas. Mm-hmm. South of Macintosh.
Yeah.
And I guess conceivably 6 kilometers north of Castle.
How is that? How does that sit chronologically? So when do you go there? Or is that happening simultaneously? What would that look like?
Yeah, great question. I would have said that we were going to first focus on the resource areas so we can move along the 43-101. But given our belief now, strong belief that we need to bring in a core rig to properly test and to potentially upgrade the resource with grade as well as resource, we're going to be doing it simultaneously. So the RC program, which started in the step-out drilling already, will be moved to the exploration side, and then the core rig will be moved to the resource areas, McIntosh and Castle.
How many rigs again?
It'll be 2 rigs.
Oh, okay. Yeah. I'm sorry, I cut you off there. You were saying it will have.
Yeah, I mean, we'll be doing it simultaneously. So exploration and core. Core primarily we're going to be used for resource definition. So for McIntosh and for Castle, RC is going to primarily use for exploration.
Right. Yeah.
And I think one of the things that, not to go off on a tangent, but the issue of availability of rigs also comes into play. And there are rigs available, there's just not enough crews to operate those rigs, or properly qualified crews. And then each individual company also needs your own personnel staff. Now we've focused the last 3 months, we've been bringing in and increasing our own personnel staff, bringing in 2, I think, highly qualified individuals, bringing in a third, which that has been helping us. So our team is almost doubled in size over the past 3 to 6 months. And now we can properly run a 2-rig program at A2Gold. And I think that's one thing. The second is, can you get a rig? And, this is when your long-standing operating in a specific area kind of plays in your favor. So a lot of these new startups who are coming into Nevada are raising money, and they now have a project. But there's a third element that no one really considers. That's, okay, now you have this money, you have your project, you got to drill it. A lot of rig companies don't want to speculate on a startup. They've been burned. And so we've been operating in Nevada, Allegiant and Columbus Gold together for 20 years. We have a track record with the drill companies, and I think we've, in general, have done a pretty good job of managing our relationship. So there's always something that goes wrong, but I think that in general, drilling companies do like working with us, and I think that can't be overstated. It's going to be it's going to be very, very tough for startup junior companies to actually get a rig.
I had very interesting conversations about that during PDAC. I went and spoke to the drilling companies. I interviewed them. I've put that out by now as well. But that's more or less what they're saying. It's not rig availability is finding qualified drillers to operate those rigs, making it tougher to operate, and therefore they operate on personal basis, kind of like when companies that they might have relationships with are the ones that they like servicing, and so on and so forth. So it's a whole world in and of itself. Another one is permits, by the way, which is something I want to talk to you about as well. Is this state land, BLM, or what does it look like?
It is, yeah. So we're on all BLM land. We're currently operating under 2 plans of operation, a combined, call it roughly 7,000 acres of our property. So I tend to think more in hectares, but call it 3,000 hectares of our property. And McIntosh operates under a plan of operation. The South Castle operates under a plan of operation, which gives us quite a bit of flexibility. We also, on the third, do have an eagle take permit, and there is a small area at McIntosh that is covered under that have eagle's nest, and those are protected. So we went to the Fish and Wildlife Service and obtained a very, very long, drawn out 4-year process. But we do have an eagle take, which we have enacted the first one this year to be able to drill 12 months a year. And I think we'll continue to do that. And so permitting is one of the, I think definitely a bright spot where we've been able to get through the permitting process in Nevada and have a significant part of the land permitted for year-round drilling.
Community relations and so on and so forth. I mean, it is It is a mining region, so I wouldn't assume challenges, but what does that look like?
I'm sorry, I didn't understand the question.
Oh, I'm just asking about community relations and any
Oh,
local communities that might be nearby.
no, there isn't any local communities. The closest town is Tonopah, which is about 35 kilometers
Mhm.
southeast of Eastside, and all around us are just mining companies, and never really have dealt with any issues or any protest on anything of our land. The second largest source of revenues for Nevada is after tourism or gaming is mining. So it is a protected industry in Nevada.
Hmm. Yeah. What's the water situation in Nevada? Well, when I think of Nevada, I think of a desert. When I think of mining, I think of water. So what does that look like for you?
So Eastside has two distinct, and I'll answer your question on how water works. We have 3 or 4 water wells on site, and it's not about water. It's about having the rights to that water, so you can pump your own water, right? So we're in the process of acquiring water rights right now. Actually, I have an agreement right on my desk to look at, and but we do haul water currently for the drilling operation, but we're looking to acquire that, and the water rights would give us the right to pump the water on site in the 3 or 4 of the water wells that are already drilled. So I think we're pretty good on that side. Not concerned about that.
Where I'm coming from with this, because just kind of still thinking about permitting RC drilling is one thing. Permitting a fully operational open pit heap leach operation is a whole nother beast. What would you or whoever wants to build this have to go through in terms of permitting, and is it really permittable? Is really what I'm asking here.
Oh, yeah, absolutely. I mean, so at Castle, there was a former producing mine called the Boss Mine, and it's one of those 4 subzones that comprise the Castle area. So when we say Castle, it's comprised of 4 subzones. One is called Berg, one is called Boss, one is called Black Rock, and the fourth one is called Castle. We decided just to call the whole thing Castle because Castle is the largest part of that subzone. Boss was a former producing mine. It produced anywhere up to 40,000 ounces at a head grade, which we estimated about 1.6 grams a ton. It was never properly reclaimed in 1991. It was a private company that produced the gold and then disappeared. The BLM owns essentially that environmental aspect, and from a permitting perspective, if we were going to put Castle into production, we would attach the Boss mine to the Castle project. And we've had initial conversations with the BLM about taking on that responsibility. And for us, it makes sense. We would take that on only if we would get an accelerated path to a permitting, which is pretty straightforward in Nevada. Even you may not even need an accelerated path. I think that in the event that there is a former producing mine, I think that if you had all your longer term studies, geotech, hydro, paleo, and everything, which some of them we've already done because we have an environmental assessment done to our property when you apply for a plan of operations. Part of that plan of operations is an EA, and we've done that. And those are a lot of the long-term studies that are required, which includes the paleo and certain types of environmental and flora and fauna. If we hit the button today and say we're going to put Castle into production, I would think it'd be within a few years.
Huh.
Permitting.
That's interesting. That's always gonna, I like stable jurisdictions like Nevada. I generally don't like the weight that goes with having a stable jurisdiction with a decent rule of law. So it's an interesting take that you have there. What do you think then is the biggest? I mean, we talked about permitting community relations, permitting a mine, connecting the zone. We talked about a little bit about geology. What do you think is the biggest risk for this program or for the company as a whole right now, if it's not any of the things that we brought up so far?
Well, I think it's our ability because of, when you're dealing with an open pit heap leach project that's grading zero point 0.5 to zero point 0.7 grams, well, the price of gold kind of influences it. As I alluded to earlier, at 1,800 gold, I'm not sure you would build a mine at Eastside at 5,000 or at 3,000, it becomes a really good IRR. At 4,000, it's amazing. At 5,000, it's spectacular. And so it is, I think it's fair to say that we are Macintosh more than Castle is a is sensitive to gold prices. Castle, given that it's literally at surface, starting at 10 meters below surface, all the way down to about 130 meters, where we've seen most of the mineralization. You're not moving a lot of waste. You can just move it up, and so it's a lot less sensitive to gold prices. Everything's sensitive to gold prices, but and that's the one thing I can't control is gold and silver prices. But if they stay anywhere near $3,000 an ounce, this is it's a very profitable project.
Mm-hmm. Yeah. So what keeps you up at night? Like, what do you think about the most, or what takes up the most of your mental energy, if you will?
Well, I mean, to properly drill out Eastside and prove up, do we have 3, 4, 5, 6, 7, 10 million ounces? It takes capital, right? Mm-hmm. And drilling is expensive. RC drilling is relatively cheap in Nevada, but it only gives you part of the picture. Core drilling is what you really need, especially in an epithermal system where you have it. RC is perfect in a Carlin type of trend where you have a disseminated gold project. And so the variance between areas in that deposit is going to be small. Epithermal is completely different. You really need a higher percentage of core than you would normally need in a Carlin style deposit. So what keeps me up at late is, can we successfully drill core at a reasonable price to prove out higher grade and size? Mm-hmm. And that's why we've always been very disciplined in how we utilize capital. Today, we're in a position where we have significant amounts of cash. We can go out and drill the project to a significant part in core. It's just, I don't want to blow all of our capital quickly. And so we're going to do this methodically. And we're drilling the largest drill program in the history of our company by magnitude of 2 or 3 times in any given year. So, what keeps me up at late? I think we're in a good position today. I'm sleeping a lot better than I was a year ago.
So you don't think you're going to raise? You don't think you're going to raise any capital this year?
You never say never. Given the recent pullback in our stock, we have the luxury of not having to be at the whim of the market. So we could, we're budgeted. The way we run our budgets are for 2-year periods of time. So we know that we don't need to raise money this year. We're not going to be forced to, and probably not have to raise money for a big part of next year. If the markets are conducive, and we feel that we can raise money on favorable terms, and we're able to continue to advance our project. Plus, we made an acquisition recently in Taylor, and we're in the process of closing that acquisition. Yeah, we would raise money on our terms. And this is one of the major differences in how we've managed our company versus other companies. We've always tried to raise money, and we've been very successful at raising money on our terms, not on the market's terms. We've never been our back against the wall where we have to take a punitive financing. And for different reasons. In the first 4 or 5 years, we did a financing in 2021. Kinross first started investing in 2022, and there was over 3 years before we raised another dollar. And we were able to survive and advance the projects by the sale of non-core projects at very, very good terms. Some of those sales are, to me, were save the company from having, as many of these companies have, 500 million shares outstanding and post rollbacks. So we were successful at doing that. Today, it's a little bit different. Today, we were able to raise, 2 financings over a very short period of time, where Kinross also came in on very favorable terms. And we just exercised some of those warrants that came in. So our warrant, we were able to get additional capital through the exercise of those warrants. What I think that when I say favorable terms is that the last financing we did, we had a 12-month mandatory hold on the stock. right? And it was we weren't going to raise the money unless we were able to create a level playing field for all investors. And this is something I've been harping on for, God, 10 years, right? There's a bifurcation of the market between Canadian and non-Canadian investors, right? So there's always been, against other investors, whether that's that 4-month hold or life offering or flow through financing and all these things that are just punitive to non-Canadians, right? And I would say that the majority of our investors recently that have come in, almost all of them that came in at the financing were non-Canadians. And so the Americans who came in said, well, it's going to take me 6 months to a year to get my paper and my legend cleaned, while the Canadians are blowing out of their paper in 4 months. It's kind of unfair. So we just slapped a 1-year hold on everything. So everyone now has the same terms.
Yeah. Another podcast in and of itself, the 4-month.
Yeah. Oh, I could go on for 3 podcasts on that one. And don't get me started on the flow through financing, because that will take another 2.
When you talk about financings, though, you really are approaching it from the equity perspective, which is maybe also telling me a little bit about how you think you might finance the company. Because I did want to ask about it, potentially a JV. Like, is that something that's completely off the table? Would you consider it? What does that look like?
Yeah, we've turned down at least 4 JV offers over the last 2.5 years. It is off the table until it's off the table just because we're a publicly traded company. If I were a private company and I, didn't care about JVing one of my flagship projects, we may consider it. But as a publicly traded company where our main flagship project is Eastside, I can't imagine us wanting to JV that out right now.
Mm-hmm. Yeah.
Especially given our cash position.
Yeah, fair. And again, the way you answered the other question kind of told me a lot about that as well. You're accounting for, so you said you don't have, so you're accounting for G&A, I assume, as well, because you said you might not have to raise money into next year. So what is, you said you started hiring more people. I suppose you also need more mining people. Like if you're thinking going the BFS route, you would need, I know you do have a team, but there's not a lot of people who have like direct experience with mining as far as I could tell. Or maybe I saw that wrong, but talk to me about that.
Yeah, that we have significant people with putting mines into production.
Okay.
But it's one of the reasons why all of us kind of agree that it's not the route we want to go at this stage. Eastside is a very, very large system. It's very large. And I think it's probably, if we could partial out Castle and that becomes a 500,000 or 700,000 ounce resource in its own right, then you could potentially make the case for putting that into production under a junior.
Mm-hmm.
But Eastside as a whole is a massive system where I think we've only scratched the surface. I mean, we have 2 ore bodies in 10 years, and obviously it should have been done in half of that time. But given the state of the market at that time, it just was not feasible. Or it was feasible, it wasn't something I was willing, it wasn't a decision I was going to make, or I voted against diluting at those terms. I think that from my perspective, I think that the best source of capital is growing a 3 to 5 million ounce deposit. Getting into pre-feasibility and other things means you want to get into an economic discussion, and that means that you've delineated the entire resource. I don't even think we've even come close to delineating the resource. Mm-hmm. So every dollar is much better invested in increasing the size of the resource than going back in and then infill drilling to get to and measured and indicated, because that's going to take millions of dollars. I think the millions of dollars are better used to continue exploring to see what your final result is for Eastside. And that's this is the conclusion I've reached.
Mm-hmm. Where do you think that puts you in terms of G&A, though, having made the new hires and looking forward to the team that you need? How much money are you going to spend? Call it an average monthly burn.
Yeah, so I'll give you a before and after. Before, in US dollars, we were running, call it $60,000 a month. We were very, call it fairly frugal in how we ran the company. And then I think now G&A, we've got to be at just G&A, we've got to be closer to 100,000 now, maybe 110,000.
Mm-hmm. Because I saw you've ramped up marketing as well. There was two new contracts. What's the goal there? Does that count within the G&A? And what are you hoping to achieve?
Yeah, so this is going forward. We were testing out a few things. I think that from our perspective, we have a pretty good understanding of what works in getting the messaging out and marketing. I think that so the 100 to 110,000 going forward looking is probably a realistic number. Right? In terms of additional marketing, we'll continue to promote the company and try to, get the message out. But I think, making larger investments as we had done or tried things is probably behind us now.
Mm-hmm. Is that, is that market dependent? Is that something you're going to kind of turn on and off, or is it more strategic based on where the company is and you think you need kind of more eyeballs to look at the updated resource once you put it back out or once you put it out?
Well, I think we have eyeballs now. Part of the reason we wanted to spend is we did a rebranding from Allegiant to A2, and that kind of getting the message out that it's the same company. There was no other change except the name change, right? And so for us, it was important to spend that money to get the message out that it's the same company, same projects, nothing has changed. It was just a rebranding. And we felt that we wanted to rebrand because we had been known, and I think it's fair, as almost too conservative in how we moved our projects forward. And the criticism that I faced over a 5-year period, and I think it was fair, was that we weren't advancing our projects fast enough. But that was based on a very, very poor market where I just didn't want to take the dilution at any cost. There was a cost, and I wasn't willing to take that. I think now our whole attitude has completely changed over the last year because we have a strong balance sheet. We were, up until a few weeks ago, we're trading at over $1.20, and that afforded us the ability to go and make acquisitions or look at acquisitions in a very, very accretive manner where we were, trading at $80 a resource ounce, and you're acquiring companies at $5 a resource ounce. And you look at Taylor, people don't realize that came with, a historical resource, and it's only historical because it's out of date. It's a 43-101 done in 2018. And, it showed 11 or 12 million ounces at $17 an ounce of silver. But if you looked at if you looked at the table that was done by the resource consultant at $30 an ounce of silver, they had 20 million ounces of silver. And I think, we've been spending some time on that, and we looked at it and thought, that there's significant potential. Now, if you look at it and you said, well, you have 20 million ounces of silver and you acquired Taylor for essentially 7 million, call it 8 million US. You acquired a silver deposit for 40 cents an ounce, right? In a market that was trading at $3 to $5 an ounce. We paid for it with shares. Now, fortunately, the shares we paid on an average price was $1.15. And so it was a very accretive transaction for us. And I don't think people are, I don't think we're getting credit for that. I think there's a whole large gold resource there that can be developed. And then you get the third bonus of the gold being attached with a significant past producing antimony assets. There's 2 mines that produced antimony at Taylor. And then there's, Nev Gold, which is, fairly close to the project to the north. And I mean, when I say fairly close, I think it's less than 50 kilometers away. That's become a $200 million company based on their antimony gold hits. So I think that those acquisitions I'll do those all day long, where I can use, when I can use my paper in the company to acquire some great assets with great potential. And that's what we did with Taylor.
Yeah. I did want to talk about that. It seems like this was an opportunistic acquisition, maybe, or is it? That's essentially what I want to ask you here, because I suppose this might be a good point to talk about M&A as a whole, and M&A goes both ways, and you're trying to A something right now, I suppose. Closing the Taylor project. Yeah, was this an opportunistic acquisition? Was it more of a structural business decision? As in, do you see yourself? Do you see it as a one-off, or do you expect doing more of those kind of like as a, let's call it, once a year type of target? Or yeah, what does that look like?
Well, we have a list of 4 or 5 projects and companies that we know, and we've known those projects for 15 or 20 years, right? So, we're always opportunistic. It's always opportunistic with us. We know our area probably better than anyone. Our team has worked on average, our technical team has over 40 years experience each on average. Some people have 60, some have 25, but on average, we know Nevada better than any other team out there. We know every single project. We've followed them. We've known about Taylor for many, many years, decades. Actually, one of our geologists worked on it in the 60s and later on the 80s. So we've known about it and we've always were interested in it, but it was under a private company. And, we just were not interested in acquiring the company. We were interested in acquiring the project, and for numerous reasons. And when I think they as all private companies, I thought they were challenged to be able to raise significant money to advance Taylor, which for us was easy because we knew the project, we knew the management, we knew everything about it, and it just came down to a price. And when they couldn't raise sufficient amount of money, we stepped in, and when it took us a while, but we came in an agreement, which I thought was very interesting for us. Now, would we do that again? Yeah, absolutely. At the right price, at the right terms, we're always going to be interested in something. And especially a project we've known about for decades, then it makes a lot of sense. Now that's going to be predicated in are we trading at a premium to them? Because we're not going to do this, by only just giving up valuable cash. I think we could do it again, but right now Taylor's a big enough project for us to absorb that I can't see anything happening over the next year again. I mean, it's the same size of Eastside. You have 2 projects that could be multiple million ounce projects.
Mm-hmm. Yeah. And how you finance that depends on the market, or depends on what would that depend on? Because again, we're talking about, something you mentioned earlier as well, is like dilution in a bull market is less, and in a bear market, maybe you couldn't afford to do these kind of deals. Or how do you think about financing these kind of deals?
I mean, it's a great question. That's what one of the things that was hidden in Taylor was the antimony side of it, and we were kind of quiet about that because antimony has become, and for the right reasons, as opposed to lithium, antimony has become probably the number 1 or number 2 critical mineral, most important critical mineral in the U.S. today, and antimony is primarily used for a hardening agent for missiles and munitions and bullets and it's also fire retardant, but most of I think the future of antimony is more related to the military aspect of it. So financing the government through Exim Bank, through the Department of Defense, War, whatever you want to call it now, and the State Department as well as the Commerce Department have all taken a strong interest in projects developed in the United States with antimony and some of the critical minerals. So not just us, I think other companies that actually have legitimate deposits will be able to tap into that, whether that's through grants or through equity investments by the government. So that's a great path that I think no one has really even discovered or even talked about. When I've gotten questions asked about why we did Taylor, we got Taylor because there's a silver resource there, there's a gold potential resource there, and then tied up with that gold's antimony. That antimony kind of gives you a backdoor into another financing avenue.
Yeah. The current administration has been doing interesting stuff, and some projects are getting much more interesting now under them. Why even think about this side of the business though before you even have that resource that you're targeting, 3 million ounces, before having that ready on Eastside? Why even target other stuff?
Well, we're not targeting it. We're opportunistic, right? So at that point, our stock was doing very well. We had a lot of cash, and we've known the project. It kind of checked all the boxes. I mean, we're not going to be looking for a project, but we know the projects. If something comes up where it's extremely highly accretive to us, which was the case at Taylor, then we'd be foolish not to look at it. I mean, I've said this before. 2 months ago, if Taylor was in the hands of a publicly traded company, it would have had a market cap of 80 to 100 million. Because similar companies with 20 million ounces of silver were trading at $4 to $5 an ounce US. And so 100 million Canadian market cap, which was essentially our market cap. And those opportunities are rare, and you need to be in a good position to be able to execute that. Now, if we only had 3 million in the bank, as opposed to 15 to 17 million in the bank, then we may probably have not done that acquisition. And, you know, having a strong balance sheet, having a strong share price relative to what was out there, if you're not taking advantage of it, then I don't think you're doing, I think you're doing a disservice to shareholders. And having a lot of money, my own personal money invested in A2, and the management and insiders are putting significant amounts of money. I mean, we kind of manage the company as if it were, to benefit us as well, because we're significant shareholders with significant amounts of money invested in the company. I mean, it's not a testament for or against Eastside. It was just like we could probably do both of them given the cash position. And if Taylor were trading at $50 million as opposed to 10 million Canadian, we wouldn't have done the transaction. That would have been suicidal for us.
Yeah.
Yeah. And so I think what people have gotten to know us as being very opportunistic on the sell and buy side, mind you, right? Like we got no credit, very little credit for selling Mogollon for 10 million Canadian 3 years ago to Suma Silver, right? And that was, I would say, a company saving transaction for us at that time.
Yeah.
Now, sometimes we'll be on the sell side, sometimes we'll be on the buy side.
Yeah. A couple of housekeeping things here. The news release that said the closing depends on the resolution of what you call some or certain historical mining interests. What exactly is going on? I mean, is this thing going to close, or is there a risk for it not closing? What's going on?
Yeah, that's an amazing question, because there's always a risk of not closing, right? So we are very, very, very deep into resolving those issues. I actually had a call last night, very late last night, because I'm on the East Coast and it was on the West Coast, but I'll be there next week as well. And I think we're making a lot of progress in resolving some. They're smaller issues, but those issues affect the actual current resource, the silver. Doesn't affect the gold or the antimony part of the resource, but it does affect the silver part of the resource. And given that the price we paid for Taylor was predicated on the silver resource, everything else was upside. So the gold and antimony came for free, and we got a discount for the silver. That's the way we look at the transaction, right? We got a significant discount for the silver, and the gold and antimony potential actually came for free. So we need to make sure that what we're paying for the silver doesn't come with some punitive other terms. I think we have a pretty good standing, but until you're finished with the title report and opinion and everything, which we've done a first pass at the title opinion report. We're just resolving a few of these issues. I'm pretty confident we'll resolve these issues.
Yeah. What's the time frame on a closing?
Well, I believe on our LOI, we said 90 days, and we announced it a week ago, essentially, or 2 weeks ago. So,
Okay.
So we have about 75 days to go, roughly. We're hopeful that we'll get there sooner.
Right. 2.5 months, actually.
Yeah. I mean, the only issue that we need to resolve is actually these issues on a few of the titles.
Yeah. Yeah. All right. I think it's been a good overview. There's loads more to talk about and a lot more details to iron out. So I hope you'll be back on for an interview. Maybe let's do a bit of a summary here. Now talking about timelines from now throughout the rest of 2026. What's the catalyst calendar going to look like? Like what kind of news release comes next after this conversation, and then after that, what do you have coming up?
Well, I think we have, we're anticipating drilling between 60 and 80 holes this year. We're 8 into it, so we're going to have a series of news releases on results. I think that there'll be more news at Eastside on some of the things that we're working on, which I think are pretty interesting. And then there'll be Taylor, the closing at Taylor, and an initial drill program to test the antimony gold side of it, and then to expand the silver because we also want to put an updated 43-101 on the silver resource. Mind you, the last silver resource was done at a silver price of $17 an ounce.
Mm-hmm.
So even if silver has come back down from 110 to 65 to 70, that's 300% higher than it was in the last resource report at Taylor. So all of those things will be happening. It's going to be the busiest year by order of magnitude at A2Gold, where Eastside is working. It'll have an updated resource report. We're doing significant drilling, and then there'll be a lot less drill program at Taylor just to test silver and the gold antimony part of it. And I mean Taylor has, both Eastside and Taylor have so much more potential that if you had unlimited amounts of capital, you'd bring in 5 rigs.
Mm. Some met work as well, I suppose, or when do you think it? Because your current met is from what 2019, I believe, and it was preliminary.
Yeah.
When are you going to do some more met work?
Well, I mean, we've done a significant amount of bottle roll testing, which gives us a pretty good understanding of certain parts of the metallurgy. I mean, the gold standard would be a column leach testing and doing a full, at least a battery of these column leach testing. I think that'll happen after this core program is done. So once this core program is done, then we'll probably, we have the core. I think we have around 15 to 20,000 meters of core sitting at our core shack in Tonopah, bringing that in and doing, a series of column leach testing for crush sizing and other things. But those are important factors. But once again, I kind of point to, we got to delineate the asset first. We got to find out, okay, we've drilled it out. There's nothing else we can discover. We have 2.5 million ounces. Do we have 8 million ounces? And now let's focus on the economics, and that includes metallurgy.
Mm-hmm. Yeah, that's fair. It's a good point for an update interview. When you think that's going to be, like sometime this summer, maybe?
Yeah, I mean, I think that the best time would be in the summer because conceivably we'll have 2 drill programs ongoing at that time. And, if things go well, closing the Taylor transaction, we're hopeful in the next 2 months.
Right. Good. Well, I'll be looking forward to that. I typically at the end, something that I would do is ask the company, what is the most fair criticism you've received? I think you actually talked about that yourself earlier, which I do appreciate. So let me ask you, what's your most fair criticism of me? What did you come here hoping to talk about that I've failed to bring up?
I think you hit on I think you're extremely well prepared. So you've asked, I think, all
Thanks.
the questions that I would have asked as an analyst. Trying to think. Yeah, I actually I don't think there's anything you wouldn't have asked that I would have asked if I were an analyst. I would have asked exactly the same things you asked. Is skin in the game? I would have asked skin in the game, not in share ownership, but how much money do you have invested, right? And that's what I think is more relevant than or your average share price, which I think you backdoored in that question. You've done a great job. Is that a Martin that you have? A Martin guitar you have in the back?
I wish. No, it's not. It's a Stag actually. It's a Belgian brand. It's kind of like a value brand. They're cheap, but they're good and they're good to learn on. I've only been playing for a couple of years now, so I don't really need more than that. Although anytime I pass through the music shop, I do look at the electric guitars. I could just never really justify because I play like, 20 minutes every other day. So do you play?
I don't. I played piano when I was a child. My son plays the guitar as well, and but he's more into the electric. I like acoustic guitars.
Yeah. Electric's pretty nice though. But you gotta like have a whole equipment for in this. I just grab it and play a little bit essentially. So yeah. Anyways, Peter, it's been a pleasure. Thank you so much. I'm going to be looking forward to our next conversation. For people watching and listening, whatever I'm forgetting, just let me know. Send me an email, put it in the comments, whatever works, and I will ask it during our next conversation. But yeah, Peter, it's been a pleasure. Thank you so much.
Thank you very much.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."